All right, everyone, we are going to get started. I appreciate you all once again jumping on today's call. Let me just make sure all my settings are good for the recording so you all aren't just staring at a recording of myself after the fact. I would love to make sure the content is actually going to be recorded. Let me get my screen share. All right, can you all just let me know when you can see the content on the screen?
We can see it.
Yes.
Perfect. Okay. And let me just get my second screen dialed in here. I love how Zoom likes to make it a little hard sometimes. Okay, there we go. I think I figured it all out. I know there's going to be some people that trickle in a little bit later, so I just want to make sure that they are covered and I can let them into the meeting. All right, so we have all had in a situation where we have either heard or seen a situation where there has been a low appraisal. So when the appraisal comes in low, that's usually, uh, some sort of difficulty is about to unveil itself. And we've got to kind of sort out what that looks like, how we can solve the problem, and what solutions are there. So today's entire meeting is going to be based on a low appraisal. And I'm going to share a story about one that I just kind of solved. But throughout my career, throughout the last 11 years of doing this job, I've had it happen obviously more than once. It doesn't happen super often, but it does happen. And when it does, we want to figure out how we can solve it. So, what we're going to cover today is why appraisals come in low, what your options are when it happens. I will talk about the deal that I closed and what I ended up doing to be able to make it work with the real estate team that I was partnered with on that one. We will talk about seller credits because seller credits are part of some of the solutions, and there's kind of a bigger picture with them. So I do want to kind of highlight that as well. And then I'd like to open the floor to discussion from any of you all that have had a situation where we can kind of talk through and share as a team, how you got through it. Because I think the real world examples are, invaluable when it comes to, the future of, someone coming into these challenges, because knowing that and how it was handled in the past can help with structuring it moving forward. So why appraisals come in low? There's a lot of reasons for why appraisals come in low. No comparable sales. So the neighborhood simply doesn't have enough recent closed sales for the appraiser to work with. The comp pool is thin or non-existent. New construction areas. For anyone that has dabbled in new construction, if you're first in a project, there can be significant challenges with getting the appraised value to come in where you need it to be. Brand new subdivisions lack sales history. Appraisers are forced to pull comps from nearby neighborhoods with adjustments that may not reflect actual value. And I'm going to come back to that adjustment section in a second. Fix and flip properties. This is a notorious one, especially in neighborhoods that are gentrifying. A heavily renovated home in an area without renovated comps, the appraiser has no basis for their comps, so they have to ultimately figure out what it is that they're going to comp the property at, and that is subjective. Appraiser subjectivity as a whole. So, appraisers are human. It's not like an algorithm or anything. And we've seen how the algorithms work in the past. It's not there yet. So, because we have a human and because the algorithms don't work perfectly, there's subjectivity. So, adjustments for lot size, condition, upgrades, locations, it's all subjective. If you have two, three, four appraisers that all go out the same property, if you don't assign a contract to that property and you just send them out, like if I were doing a refinance to a property, they're all going to come in at a different value. Now, the beauty of a contract is a contract has what we're trying to work to get to, which can be a reference point. But if you send four appraisers to the same property, give them no reference point, they're all going to have a different number for what it looks like. We've seen this in the past, and we've seen it a little bit now in very specific neighborhoods, but the market's moving faster than the comps. So specifically, like during COVID, when we were seeing 10 to 20% appreciation year over year during some of those crazy years, appraisers were having to stretch the imagination to get to the value of the contract because that's what it took to get on a contract. People were offering 30, 40K above list price. And so they had to find a way to do that. And they weren't always successful. Right. And then the last bullet, and this one, I've only come across a couple of times in my career. I've always been lucky, but unique or custom properties. I had a deal that I saved a couple of years back where a client was working with another lender, and this particular property had one of those like safe rooms, like a massive, massive safe room within it. Whoever built it was very serious about security. And because of how expensive safe rooms are, the sellers wanted some form of reflection of that in the value of the home. And of course, the appraiser looked at it differently with the first firm. So, when I took it over, was able to rescue it. But, it was a very interesting, dilemma because there's no comps for that. Right. There's not really safe rooms in, a short time distance away from each other where you would typically pull comparable sales. It's just a very rare thing. So, these are all various reasons for why appraisals come in low. The biggest being subjectivity. So what are your options? So let's say you do have an appraisal that comes in low. What options do you have? Well, the first thing I want you to think about is mentality. So you as an agent, you have the ability to think of this as just like another inspection, right? So you have a low appraisal or you have an inspection that shows some sort of problem with the house. First thing we're going to do is we're going to look at that, together with our clients ourselves, and we're going to say, okay, what's going on here, right? Usually where we start, and this is always for the client's sake, it's not for the sellers, is we start with a reconsideration of value. So reconsideration of value, otherwise known as ROV, is a standardized procedure in the lending business where we go back to the appraiser and we send them some sort of comps or details that they may have missed. Now, it's very important that we do a couple things prior to submitting this. First, we look at the appraisal and make sure there's no errors or omissions that could be material, because if they have somehow forgotten that the square footage is 2,000 or 3,000 square feet and put it at 1,800, there might be an issue, right? They might have missed a bedroom or something. These are, again, humans and things happen. So when we're doing the reconsideration of value, we want to look at the appraisal first and fine tooth comb and look at it in good detail to make sure that there's not big errors and omissions. Assuming there's no errors and omissions, the next thing that we want to do is request this ROV. And part of the ROV is pulling together the comps. And now you can do this with the listing agent. You can do this with yourself. Typically, when you're submitting an offer for a purchase, with your buyers, you would have already looked at comps to make sure that we're somewhat in the ballpark, right? And so you might already have some homes that are saved. See if those homes are referenced in their appraisal report. If they are, see what adjustments were made. See, based on the appraiser's adjustments, how they got to their number, because that can tell us what they may be missing that we looked at, or you looked at when you were strategizing with the buyers on the offer. Share with the listing agent. Listing agent wants this to come in as high as value as humanly possible, but let's not mistake that for, giving them leverage in a negotiation. We're still trying to do an ROV, but at the end of the day, we're still going to negotiate based on the fact the appraisal came in low. But the key is we start with an ROV because this takes a couple days to come back. The appraisers, we have to submit it through a portal that's independent. The portal has to review it, confirm that we're asking for something that's legally being able to be asked. And then they'll send it off to the appraiser and they'll have 2 to 3 days to respond. In my experience, ROVs are very hard to get to come back at a higher value. Appraisers, when they submit their data, they will typically, like when they submit the report, they submit a value on that home and that gets logged in their registration system. So when they submit, it's kind of they have to basically go against what they've already written to come up with a higher value. So they basically, when they do an ROV, if they do come up in higher value, they're stating to Fannie Mae, Freddie Mac, whichever the loan was done through that portal, that they made a mistake and here's why. So getting them to overcome that, you're asking someone to basically admit to a mistake, which is hard. I think we've all experienced that with just about any facet of professional world. But that's the key, is getting them to see that there's additional comps that may not have considered and see the adjustments that they may not have considered to get them to come up. So that's step one. Step two is, guys, going back to think of this as like an inspection. This is now a negotiation tool. So we have a low appraisal. The sellers may not love it, but at the end of the day, that's what it says. Use it. Send it to the listing agent. Say, hey, look, we have a little appraisal. Just like with any other inspection that has some sort of issue, our buyers may want credits from this. And we should use it as a negotiation tool always. Never just say as an agent, well, we have a little appraisal. Let's figure out how the buyer can come up with the funds. Let's use that to go back to the table. Now, let's say we do, go back to the table and the sellers play real hardball, right? And they know what they have, the phrase you've always heard, right? I know what I got, and they're not going to come down. It is their right to not renegotiate with the buy side. So we may have to have the buyers come up with additional funds, or may have to restructure the deal in some way to make it work. This is always an option, right? It's not the option the buyers love. It's not the option that we love, but at the end of the day, that is an option. I like restructuring with credits because when I can get credits, I can figure out a way to make it as painless as possible for the buyers. Okay. So getting seller credits, in my opinion, is almost as valuable and sometimes more valuable, and we'll talk about that, than getting a price reduction, depending on the gap. I'll talk more about I'm going to share my story about my one I just closed, and I had a very large gap and how seller credits were able to bridge it for me. They are a valuable tool. The last thing you can do, and this is the most painful one, is we can walk away, right? Sometimes the value of the home isn't there. And sometimes the seller's dad's cousin, sister's mother's brother knows better. And, we can't put it together. And so sometimes this is the only option. We hate it. And obviously it's a loss for everyone, but this is an option that can be explored. Here's how we'll navigate an ROV. So you're going to pull your comps. You're going to find things that are relevant. So guys, you got to keep that short. You can't be going 5 miles away on comps unless we're really rural. If you're in city, it has to be within 1 mile. And then you send them to us as a lender, and we will send them through the portal. ROVs, like I said, take 2 to 3, sometimes 4 days to come back. So we want to make sure, again, that's one of the things that we're first doing. If we're navigating seller credits, again, send the appraisal to the seller, and let's talk about that just like we'll talk about the inspections. Maybe couple it all together, get everything all at one time. So you have your repair request and you have your renegotiation or you have the appraisal, so you can renegotiate everything as a whole. Having all that to kind of throw at them, that's a lot for the sellers to take in and not agree to some sort of adjustments. We can talk about this a little bit more throughout this presentation, but if we do have a low appraisal, once the list side knows about it, that could be a complication for material facts. So should the seller say, hey, I want to go back to market and find a new buyer, there is some complications with material facts when a listing agent does know that there is an appraisal that came in low. If we're covering the difference, like I said, where the sellers are not, negotiating and our clients have to bridge the gap, or they did negotiate, but there's still a slight gap that we need to fill. We'll work through that with our clients and with you and kind of make sure everyone's on the same page so that as we're moving forward through due diligence and going past that date, we have a clear plan, a clear strategy. Going back to navigating seller credits, again, you have, your leverage with a low report. We're going back to the sellers, we're going to the agent, we're asking for some sort of credit so that our buyer can have some sort of benefit from the situation. We don't want them to only accept that they have a low value. If we can get them some credits, we can do a PMI buyout. We can, use those credits to reduce their closing fees. We can help that bridge the gap in their total cash to close. There's so many use cases for seller credits. It's very good. And then, of course, for walking away, ideally, we want to do that before their earnest money date. Make sure they get back at least part of their deposits. So what makes a strong ROV? Closed sales last 90 days. If you can find something in the same neighborhood or same subdivision, ideal. Similar square footage, bed, bath count. You want to try to keep it as similar as possible to your subject property. The moment you have to shift into different bedroom, bath counts or different square footage amounts that are noticeable, you then have to deal with the subjectivity of the adjustments, right? Based on whatever metric is different. And again, that's human and hard to get past. If you're getting your ROV rejected, a lot of times it's because you're using pending sales. Pending sales are not comps, or they're older. The comps you're using are older than 6 months, or they're very large or very small in comparison to your subject property. There may be a garage, a building, a porch, you name it that provides additional value to a home. It can be why it gets rejected. And the appraiser, they do have to comment on your specific comp. So when we do submit the request of reconsideration of value, they do have to say why they're not using the report that we're giving, or the comp that we're giving. And they do have to respond to that. But the point is, a way to avoid that is to make sure that we're keeping everything as similar as possible and as tight of a window as possible. It's relatively simple for you guys to submit this. It's just, we fill out a form on the lending side based on the property addresses that you give us, as well as some additional information if you feel like there's material fact differences. So if you think the bedroom count's wrong, or you think the square footage is wrong, or you think there's something missing from the property that would add value, like a garage, a building, porch, so on and so forth, that needs to be part of the reconsideration. What we cannot include in the reconsideration is our version of the adjustments. They're not going to look at that. We can't say, well, I would have adjusted X property, by this amount because of this. The appraiser doesn't have to respond to that. We need new comps or material fact differences, and that does not include adjustments. Material fact differences is omissions. So if we renegotiate after a low appraisal, there's lots of different outcomes that we can do. So price reduction to the appraised value. So this is like your very easy, let's just lower the purchase price. Seller meets the buyer halfway, split the gap. We've all done some sort of fair negotiation when it comes to this. Seller credits is on the table, as I've mentioned over and over. All of these have different implications for our buyers and the sellers themselves, but they're all part of the renegotiation. How we frame the conversation. You guys are master negotiators, so I'm not here to teach you anything, but just make sure we lead with the appraisal, right? The appraisal is, again, just like an inspection. It shows issues. And when the list side knows that and they can share that with the seller, instead of us negotiating against ourselves, let's see what they offer, right? And see what terms they can come up with. I mean, we can lead them into kind of what we're looking for, what the buyer would make sense to see. But let's send them the report. I cannot tell you how many times I've seen on these in the past where the buyer's agent didn't want to send the report. There's no harm in it. It's low, it's low. Price reduction versus seller credits. So a price reduction will lower the loan amount for the buyer, as well as the monthly payment. A seller credit keeps the contract price intact, which may be important, especially for builders. So if you guys are working new construction, they don't want the price to reflect lower. So this could be helpful for them. But having credits can offset some of the cost difference that the buyer may have to incur because of a low appraisal. When the sellers won't move, I said, some people know what they have. That is their right. And at that point, that's up to us to work with the buyer to go over, restructuring or walking away. At the end of the day, walking away is the one we hate the most, but sometimes it happens. It depends on the situation. But that's ultimately what ends up happening there. I love seller credits. I think I've said that 2 times already. I love them. And here's why. Seller credits work better than price cuts in many occasions. There is a limit to it, but in many occasions you can use it for offsetting the cost difference. There's X amount of closing costs on a deal. If they were putting 20% down and now because of low appraisal, they're above that 80% loan to value. Now they have PMI. Well, let's use seller credits to remove the PMI. They no longer have PMI. That's what most people put 20% down for. Nothing else changed with their loan. They're happy. Right? That's a very easy one and also a cheap one too. So if we're kind of on the cusp of that 80% LTV, we can do that with as little as a couple $100 and as much as a couple thousand. But that's a lot better of a deal for restructuring it than asking the seller to cut the price $10K because they may not do it. Right? So if we ask for $2,000 by the PMI, Buyer gets the same terms they were offered in the beginning. Seller gets, not too much off the top. Usually that's a win. There is credit ceilings for seller credits. And I actually have a table to kind of go over that. Might be a little easier to read. So we'll come back to that. But let's talk about appraisals themselves. There are some rules. So an FHA appraisal, and this is a very important detail for both buy side and list side. The value of an FHA appraisal is stuck on the property for 6 months. So if you're representing a buyer and you get a low appraisal on FHA, whether the seller wants to tell people that the value came in low or not moving forward, irrelevant. It's logged into FHA system. So any buyer that comes in with an FHA home loan on that property moving forward is going to see that it's low. So that either means that on the list side, they can no longer take FHA offers if they go back to market, or if they do, they're going to run into the same problem over and over again. Jenny, did you have a question?
Oh, nope.
Okay, no worries. I saw your mic pop up. I wasn't sure.
I'm sorry. Yep. Nope, I don't.
All good. Conventional does not have that same rule. So on a conventional appraisal, there's nothing that sticks to the property. But as I said earlier, there can be material fact issues that listing agents may have to navigate. That's more of a conversation for your brokerage, and then any attorneys as necessary. But there's not the same requirements. So it's kind of an important distinction. But when you are representing a buyer, especially if it's an FHA loan, you can use that leverage of knowing that if they go back to market, they have to remove half the buyer pool to not have the same challenges. You can use that to kind of twist the knife a little bit, because of course the seller's agent may not know, or if they know, you can reaffirm that with them so that when they go to their seller, they're like, hey, look, I'm sorry, this is the situation that we're in. We don't want to go back to market. Let's negotiate with these buyers. Let's make this deal happen. And it's all part of the leverage that we can get. So knowing this rule is very important, because a lot of agents do not. All right, so let's talk about my deal that even got us to this point today. So I had a contract that came through about a month ago, and the client, they were putting 20% down, which is helpful, and I'll get to why that's helpful in a second. They were offering on a property that was a new build off a tear down in a very old and established neighborhood that has not really seen fix and flips too much. It's still kind of the older crowd that's occupied since the 70s and 60s, that same neighborhood. So it just hasn't seen a lot of the new buyer pools come in that do the renovations, that do the flips, all that. Just hasn't seen a lot. So it was a challenging appraisal, to say the least, for any appraiser. And I knew when we got the contract and I talked to the agent, they had already talked to their buyers that, hey, this is going to be an interesting one. And I knew once I saw it that it was going to be a challenging one too, because I was familiar with the neighborhood. So what happened was the appraiser went out and they came back 40K under value. Now that's a big number to be swinging. 40K that's a scary one. And so I sat down with the buyer and I sat down with the agent, and we all did a three-way call to go over the options. And in that first day, a lot of what we were doing is kind of looking from a wider lens at everything as a whole. Does this scare you? Do you still want the house? All that. And we were also talking about preliminarily what we could propose. The buyer loves the home, doesn't want to leave the home. Home's great. That's what they want. They want to get a house. So how do we negotiate? Well, first we have our back pocket, best case, worst case scenario. Back pocket is our worst case. And that scenario was that we don't get anything. And we have the clients either just pay PMI because they're at 20% down already. And, the minimum down payment for the loan is, 3% since they're first time home buyers. And the PMI, I think, was like $200 a month. So that's worst case scenario, is their payment goes up $200 a month. Now, we don't want that for them, but that was our back pocket. So they knew that they weren't going to lose the home per se if they decided to move forward and the sellers didn't negotiate. They knew that their terms were going to get worse. So our job, buyer, agent, and myself, is to figure out how we can negotiate with the list side. So as I said already, we start with the ROV. So we did submit an ROV. And then while we're doing that, the buyer's agent went to the list side and just sent the report and said, hey, we're gonna have to figure something out. Now the seller does a number of these teardowns and builds, and they do know what they have. It's not their first rodeo, and they're not necessarily wrong. The appraiser just didn't have comps, but the house is totally worth almost every penny of what the contract was there for. It just there's no comps, and so they were playing hardball. Didn't really give us a lot, but ultimately we ended up getting 5K from them. That was like a little gimme. Doesn't impact the seller too much, but for us it's huge because our cost for the PMI buyout was about $2,000. And that means that if we can buy out the PMI, we keep the same terms that we had for our clients prior to, where their payment doesn't change. They still get the home and we're good. It's all square. But 5,000 is more than 2,000. So now we're actually in the green. Clients are coming out better than they were before. Now the buyer's agent did something that, I don't see too often, but they felt bad. So they added an extra 2K to the deal. And so the buyers truly came out better because not only did they have no PMI on this loan, even with the low appraisal, but they got extra credits to compensate, for the situation. And now they're in the green on their closing costs and out-of-pocket figures more so than they were in the beginning. So even though the appraisal came in 40K below where it was supposed to, because of us looking at the options and then getting the credits, they actually came out better than they were before. Now they still have a low appraisal. That doesn't change, right? And they still know that they have a low appraisal. But remember, they wanted the house. So for them, it doesn't matter. And they got the house and they came in with less money than they did prior to the low appraisal. So going back to my point that I wanted to mention before, is this is part of renegotiation. And getting these credits can be the difference between the deal being saved and the deal not being saved, or just the difference between the clients getting a good deal or not getting a good deal, right? So in this case, our clients felt like they got a good deal and they were very happy. So for me, why I wanted to share this story, it's unique because they put so much money down and, we were able to get, the credits from not only the sell side, but the agent, but they got the money, they got the home for less. They have no PMI despite the low appraisal. They had more money stay in their pockets and they got exactly the home that they wanted. And I think if we kind of look back at like what the wins are when we help a client buy a home, these are the type of things that clients are looking for the boxes to be checked on. Did I save money? Did I come in with less than I expected? Did I get the house that I wanted? This is a win. Even though we had a very big hurdle to overcome, a huge speed bump, we got through it and clients left very happy. So one of the last things I want to share today is I want to talk about the various ways that you can use seller credits to help clients win. Seller credits, are part of these strategies and, they can be the difference between keeping the deal alive and not alive. Some clients are looking for some form of savings or some win if they're in a bad situation with, something like a low appraisal or a bad inspection or something. So if we get credits from the sellers, we can use it to do lots of things. So temporary rate buy downs can reduce their rate by 1 to 2% for 1 to 2 years, right? And that could be a significant amount of money that they spend less in that first year or so as they go through their transition of renting to buying or whatever the situation may be, which makes it more lucrative for them. Or they can do permanent rate buy downs. They may not chip off as much of the rate itself, but savings is savings. And, there's a real tangible benefit of having a lower interest rate, as we all know. So you can use seller credits for that. As I talked about for my structure, for my client that, had their situation pop up, we did a PMI buyout. Very underutilized tool. This has been around since as long as I've been in the business. Very few people do it. It can be quite beneficial because PMI can be quite expensive. It just depends on the situation. And so this is one of the many use cases. the easiest thing and the one that's used the most is reducing cash to close. So the client has $10,000 in closing costs and you got $10,000 in credits. Guess what? Now they don't pay any closing costs. They're just paying their down payment. Very simple win for a lot of clients. Prepaid item and escrows, maybe they don't get all their closing costs paid, but we can get part of it. So we can cover some of their taxes and insurance. That's a win, we're helping them save money. But you can combo all of these, right? The closing costs can go, or the seller paid credits can go towards any one of these or any combination of the above. It just completely depends on how much credits we're able to secure for them and where they want it to be applied. Now, as far as credits go, there is a lot of stipulations based on the different loan programs. So for conventional, if you're doing less than 10% down, you can only get 3% of the sales price as a credit. Now, if you're doing more than 10% down, you can get up to 6%. If you're doing more than 25, you can get 9% of the sales price. I've never seen a credit more than 6% in my entire career. That would be pretty impressive. But if you can ever secure that and the client's putting enough money down, there you go. FHA is 6% across the board. Very fair. VA is technically unlimited, but I've got to put a huge asterisk on that because even though it's unlimited, there is a threshold where they can determine that it's excessive. And so excessive is subjective. I love that, but it is with an asterisk for a reason. And USDA is 6%. So again, these are the max concessions and the max seller credits that a seller can provide to your clients. So I'd like to open the floor now, A, to questions, but B, if anyone has a short appraisal story that they have, I'd love to hear how you got through it. Mine was very specific to that client, but there's many other, situations that have come about that I'm sure you all can share, and I'd love to hear it. But does anyone have any questions about anything that I covered today? Oh, well, there's got to be a question somewhere. Eddie, you've got a question. I can see it on your face.
No, I'm just listening. I was just thinking back. I'm glad they have tightened up the appraisal industry a little bit. I helped appraise properties back in the early 80s,
Yeah.
and you could basically take a picture of a mailbox and put a value of a house in the deal and send it in, and they would accept it. That's before the first real estate crash.
Yeah. I've seen it. I wasn't around before 2015 in this business. So, I missed a lot of the craziness that was happening prior to the 07, 08 cycle. But, I've seen it in my career alone where there has been a tightening of the belt in various ways. You used to be able to challenge the appraisers specifically on their adjustments, and now you can't really do that. It's more so you have to add new comps. And so like just in that timeline of the last 11 years, it's become even harder. But yeah, that's interesting.
We just went through county reappraisals here in Pender County, and there's a lot of appraisal subjectivity being questioned from a
Yeah.
tax perspective.
I do think, this is more philosophical, but I do think there needs to be a little bit more regimented rules on these types of things. But, I'm not smart enough or creative enough to set the procedure up for that. So I'm going to let the industry figure it out with time. But subjectivity is almost always your how and why. You and a listing agent can say, well, this is absolutely worth $400,000. And the appraiser comes in and says, well, I think it's 350 and here's why. And then you got to deal with that. One thing I did not cover, guys, if there ever is a very specific issue with an appraisal that can be listed as material, meaning they're omitting something about the property or something's inaccurate and they are unwilling to fix it, you can always order a new appraisal. So that's both FHA, conventional, VA, USDA, all of them allow for that. You just have to document from a lending standpoint, we have to document what the material fact that is being omitted is. And so that's where your help comes in, sharing what that is. And then we submit that through the independent appraisal agency and then they document it and then order new. It's all very compliant now, but that is a possibility.
Who covers the cost of that?
So a lender cannot double charge a client for an appraisal unless it's one of those types of deals that requires two appraisals, like a bridge loan or something like that. So that would be covered by the lender side.
Thanks.
Yeah. So does anyone have any stories that they've had in the past of short appraisals? See a lot of microphones muted, so I'm going to take that as a no. So before I let y'all go, I'll share one more story. For those of y'all that are familiar with the Charlotte market, Charlotte has a lot of sub neighborhoods, just like every city, but Charlotte has some that are very creative, some that are very young to come into money, very old money, very, insert various adjectives here, lots of little sub markets, right? And so there's one in Charlotte called Noda, which is a very, hip and trendy, kind of artsy neighborhood and has a lot of walkability. And it's relatively close to these railroad tracks that if you go to the other side, it's a very different neighborhood, not very artsy, not very walkable, not very this, that, and the other. And so I was doing a deal back in 2021. So this is during peak COVID when values were just astronomical. And the appraisal came in low. It wasn't terribly low, but it was low. It was like 30, 40K. And we had to figure out how to resolve it because the client didn't have the ability like my other client had to put as much money down, and they were now below the minimum down payment threshold. So we looked at the appraisal, we reviewed it, and we quickly realized that they were looking at comps across the tracks. And across the tracks to the point, it's not walkable. It's not in the same neighborhood. It's a completely different neighborhood. The house sizes are all completely different. And the only reason we found out that the appraiser used that neighborhood instead of the neighborhood of Noda was that this house was relatively small and they couldn't find as small or comparable of a home that recently sold in Noda. So they went across. Now, we also found out this appraiser was from Chester, South Carolina, which is a very different market than Charlotte. And so, they were doing their best, but just weren't familiar with the neighborhood. So anyways, we took all that information and we decided that we were going to ask the appraisal management company if we could order a new appraisal because we felt like there was material facts that were being ignored. The material facts being the neighborhood itself. We're looking too far away. We're not looking close enough. We're not looking at comparable homes and doing what we would typically do, which is the adjustments based on them being bigger than our subject property. And so the appraisal management company, they reviewed the case and they agreed with us. And so the point of me sharing the story is that when we come into these challenges with clients, as much information as you all can gather and figure out from your review of the appraisal, that is what's most helpful in getting these situations figured out, because we did get a new appraisal. We were able to get a value that was much more reasonable, and that deal did go through. But without having that information and reviewing that appraisal specifically in as detail as we did, we wouldn't have gotten that ROV back or a new appraisal that would have a better value. We would have had to re-strategize with the client and they would have lost. So my point for you all is like when this happens, you all are much more versed than us as a lender at comping, right? You're much more versed at adjustments. You understand the values of these things much better than any lender ever will, because this is stuff that you all learn within your brokerages. So you all become the eye set that we're going to rely on to be able to make our case. So it's a very much a team effort. And so as much as you can dig into detail on these, that is what helps. And so if you are a newer agent and learning how to do comping, I would encourage you to do as much training and learning as possible on that, because you may be very fortunate and not have a ton of appraisal shortages, during your early part of your career, but at some point it will happen. And so if you can figure out, these things sooner than later, you will be already ready to go, with all the information you need to tackle that when it becomes a thing. But that's my last thing. I don't have anything else to share. So unless anyone has any questions, I'll turn your time back over. I know I've taken a lot of it today.
Thank you.
Thank you,
Of
Ian.
course. Of course. I appreciate you all. Have a great rest of y'all Tuesday.
Enjoy New York.
I appreciate it. Thank you.
too.